basically what you're doing is you're going in and you're buying. Well, we can do it right from here. Yeah, let's go into here. Let's see. You're buying a covered stock scenario, and we're going to do 5 shares here, 500 shares and 5 contracts. And you can see that it's just the opposite of a covered call strategy. You have unlimited upside potential and very limited downside risk. Let's uncheck this and go back to our covered stock or covered call position. You can see that you have limited upside potential and unlimited downside risk, which is just the opposite of really what we want to do. With our covered stock position, by buying the put and buying the stock at the same time, you have very limited downside risk and unlimited upside potential. That's what we want to do. Now, there are strategies like I mentioned. Let's go back to the trade tab for a second. There are strategies in which you could use a call strategy, writing a call strategy against your stock, but we start out with a covered stock position. So we've got our covered stock on, and then at a higher strike price, we sell some calls against that. And what that does is basically allow you to help offset the premium of your insurance. Your 17.5 calls are going to cost you 55 cents for each of the calls that you're buying, and you can use the sale of the 19 strike price calls to help offset that cost. So let's go ahead and analyze that. And what that does is basically bring up a graph like this, in which you have a limited downside risk, and you also have limited upside risk because you've sold a call against your stock. Some people like this strategy. I don't particularly like this strategy and do not employ this strategy. There are strategies in which it does help to pay for your long put by selling the call against it, but against your stock. But the limited upside potential is not particularly attractive to me. Also, there are strategies though that if you do this, if the stock does not move or it moves only up slightly, you can generate some income doing that. But I prefer not to have that. I'd rather have limited downside risk but unlimited upside potential. Because I only want to pick stocks that are actually going to move, and move in either direction is fine with me. I prefer it if they move up, but in some cases, they don't move at all, in which case I lose a little bit of my insurance. But that's just me. I mean, you can do this covered kind of what they call a collared position. When you sell a call against your put that you're buying for insurance, it's called a collared position. Now you have to be careful though that you do not sell a call at the same strike price as your put. Because if you sell a call and you buy a put, that is a short, synthetic short position. Just like stock, you'd be synthetic short of the stock at the same time you're long the stock, and it's called a conversion. Let's see what happens to our graph if we should actually sell the 17.5 call here. You can see that we have locked in a loss of $335 here. We cannot make a profit on that position because we're short the stock and long the stock at the same time at the 17.50 price level. So you have to, if you do this collared strategy, make sure that you use a strike price that is higher than the put option that you are purchasing. So if you wanted to do something that was in the money on the put side, you'd have to go up to you'd have to go up to the 20 strike price on the call side in order to make this an effective strategy. But like I said, it's not. I don't like collaring stock only because I've lost the upside potential that I'm really looking for, and I'm only interested in purchasing stocks that have some movement potential either to the upside or to the downside. So that is not a great strategy for me. Covered collar stock, covered calls are not particularly attractive. Now, some people are asking me, how do you pick the stocks that you're interested in using for this strategy? If we're going to be doing this type of strategy, obviously you want to have the stock that you believe in. You want to have a stock that actually has some upside potential to it. Yes, you've got your insurance in place, and you know what to do with the insurance in case the stock goes down. You cash in your policy. When stock moves down, your put will actually increase in value, and you'll be able to cash that in to generate some additional cash, not only to buy more insurance, but also to buy more shares. That's how you can leverage this. It's almost like a pyramiding effect. You pyramid your winnings in your insurance policy from your put and put it back into the stock to buy more stock. There's no more money out of your pocket in order to buy that stock. And now you've got a larger position, so if the stock does rally, you can exponentially increase your earnings, increase your profit potential on that stock, which is really a fantastic deal. So, it doesn't matter if it goes up or down. Now, all we want really with this kind of a stock position is the stock to move. We want it to move down, we want it to move up, but we want it to move. We don't want it to just sit there. So that's why I said if we have a position in which, like in Starbucks, if we have, if we bought the stock over here and we're sitting here a month later and it's still at $17.50, and we bought it at $17.50, well, maybe the potential for that stock to move has decreased somewhat, and we may want to get out of it. If you think it has potential to move, then you might want to reinvest in another month of insurance. But I wouldn't give it more than a month or 2 months at the most. If the stock hasn't moved by that time, then I'm out of that stock and I'm into another stock. Now, how do you get stock ideas? Well, a couple of different ways. One that I prefer is to use the Investors Business Daily IBD 100 stock list. I use the IBD Big Cap 20, which comes out on Tuesdays. And I also use the IBD 100, which comes out over the weekend and is updated every single week. Either one of those lists, the first, I'd say the first 15, first 20 stocks on each one of those lists are excellent candidates to do this kind of strategy with. There are other places that you can obviously look, but the IBD 20, the Big Cap 20, and the IBD 100 are really excellent candidates because those are the strongest stocks that Investors Business Daily has identified in the marketplace at any one given time. Another rich source of ideas is Barron's, which comes out weekly, and also the Wall Street Journal. I mean, once in a while I read the Wall Street Journal, but I kind of like the list of the IBD 20, which are the big cap stocks. That gives you pretty much some of the larger stocks in the universe of stocks that have not only large volume, daily trading volume, which is important for liquidity. I don't like to get into a stock that trades less than 1 million shares a day. I prefer stocks that trade anywhere from 1.5 million on up because it does provide extra liquidity for your trades. And also, there's usually quite a few. There's a lot of good options available on the exchange for the stock itself. For example, let's take Starbucks here. Starbucks has pretty liquid options. You can tell if they're liquid, not even by looking at the volume, but looking at the bid-ask spreads. So the at-the-money July options has a 2-cent spread. They're bidding 44, they're asking 46. So that's pretty tight spread for a stock. If you take a look at something like EDU, which is a Chinese company, trading, the at-the-money July options have a 20-cent spread between these two. It's a little bit more volatile stock, but still, a 20-cent spread is pretty big. If you take a look at something like SWN, which I've been following, it's a 10-cent spread. I don't mind a 10-cent spread between the bid and the ask on the at-the-money options, but once you get to the point where they're like 15, 20, 25 cents. I've seen even worse on some stocks. But the question is, I guess, let's go through the Big Cap 20 for the Investors Business Daily again. They have some of the biggest stocks that have not only the biggest stocks that have the greatest fundamentals,